If you create money, it's a crime. If a bank does it, it's business. And if a government does it, it's policy. So the real question isn't who prints money, it's who's allowed to. If you want to understand how money actually works, not the textbook version, subscribe to Capital Anatomy.
You wake up one morning. Your bank account is low. Rent is due. So you open your laptop and create money. Not borrow it, not earn it. Create it. Few clicks, couple zeros, problem solved. That sounds illegal, because it is. But somewhere else, right now, someone is doing exactly that. Legally, calmly, with a suit on. This video is about why governments can print money and you can't. And the answer is not what most people think. Because this isn't really about paper or printers or even money. It's about power and math and a quiet agreement we all participate in, whether we like it or not. And right now, that agreement is being stretched. Let's start with something uncomfortable. Every dollar you've ever earned was created by someone else first. You don't create money, you receive it. Your paycheck, your savings, your investments, they all trace back to a system where new money is born long before it reaches you. And that system has rules, very specific ones, rules that don't apply to you. When people say the government prints money, they imagine trucks of cash rolling off presses. That image is outdated, almost quaint. Most new money today is created digitally, typed into existence, not by the Treasury, but by central banks and commercial banks. Here's the simplified version. When you go to a bank and take out a loan, the bank doesn't hand you someone else's money. It creates new money on the spot. A number appears in your account. Debt on one side, money on the other. That's legal. That's normal. That's how modern economies work. So, why can banks do that, but you can't? Because banks have a license, and more importantly, a backstop. Governments sit behind banks like a silent guarantor. If things go wrong, the system steps in. Liquidity facilities, emergency lending, bailouts with nicer names. You don't have that. If you create money, it's called counterfeiting. If a bank does it, it's called credit expansion. Same result, different permission. Now let's zoom out. Governments don't technically print money whenever they feel like it. They authorize it. Central banks exist to manage this process, to keep inflation low, employment high, markets stable. That's the theory. In practice, it's messier. When a government runs a deficit, it needs money. It issues bonds. Those bonds get bought, often by banks, sometimes indirectly by the central bank itself. Money gets created. Assets go up. Debt grows. And here's the key part most people miss. Printing money doesn't make a country richer. It rearranges who gets richer first. New money enters the system at specific points. Banks, financial institutions, government contractors. By the time it reaches regular people, prices have already adjusted. This has a name. Most people have never heard it, but they feel it every day. The Cantillon Effect. Those closest to the money printer benefit most. Those furthest away pay the price. Inflation isn't just higher prices, it's a transfer. Quiet, legal, invisible if you're not looking for it. Now here's the irony. Governments are told they can't just print endlessly. There are limits. Inflation, currency collapse, loss of trust. All true. But those limits are fuzzy, political, often discovered only after they're crossed. So governments push, carefully at first, then faster, because the short-term benefits are seductive. Printing money delays pain. It smooths recessions. It funds wars without raising taxes. It keeps markets from imploding today. The bill comes later. and later is always someone else's problem. You, on the other hand, don't get that luxury. If you spend more than you earn, you're irresponsible. If a government does it, it's called fiscal policy. If you create fake money, you go to prison. If a government dilutes the currency, it's called stimulus. Different standards, same arithmetic.
Now let's talk about the math everyone avoids. Printing money doesn't create value. Value comes from goods, services, productivity. Money is a claim on that value. When more claims exist than real output, each claim is worth less. That's it. That's the core equation. You can't escape it. You can delay it, you can disguise it, but eventually it shows up. In prices, in asset bubbles, in inequality. This is where hype collides with reality. You'll hear that we printed money and inflation stayed low for a while, because inflation doesn't hit evenly. It hits assets first. Stocks, real estate, crypto, anything scarce and financialized. Consumer prices lag until they don't. Then suddenly everyone notices and acts shocked, as if the math just changed overnight. It didn't. Now ask yourself this. If printing money made everyone richer, why stop governments from doing it constantly? Why not erase poverty with a keyboard? Because money isn't the constraint, reality is. Labor, energy, resources, time. Governments can print money. They can't print oil. They can't print skilled workers. They can't print trust. And trust is the real currency here. Your money works because everyone agrees it works, because they believe tomorrow it will still buy something. Once that belief cracks, everything changes fast. History is full of examples. Not dramatic at first, just subtle erosion, then acceleration. Now here's the part that makes people uneasy. You do participate in money creation, just on the wrong side of it. Your savings get diluted. Your wages lag prices. Your purchasing power erodes quietly. No announcement, no vote, just numbers moving. And you're told it's necessary, temporary, under control. Sometimes it is, sometimes it isn't. Governments can print money because they control the legal framework, the banking system, and the enforcement of value. You can't because you're downstream of all of it. Not because you're irresponsible, but because the system isn't symmetrical, and it was never designed to be. So here's the unresolved question. If money can be created without limit, but trust cannot, where exactly is the real boundary, and how close are we to finding it out the hard way?